All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by CNBC's senior stocks correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How you been?
I've been good. How about you?
Spring is coming. It's, I don't know, it's almost 60 degrees out, sun's shining, so it's a long slog. It's been a long winter.
Yes, for sure. So yeah, let's jump right into it, Bob. There's been a lot of things on investors' minds recently, from inflation to the Fed to the crisis in Ukraine. So it's been another volatile week. Where do we stand with markets now?
Well, it's been a big rally in the last 5-6 days, but it still feels very tentative. I think everybody's still very focused on the news out of Europe, obviously, and Ukraine. But the main story is the market's very dependent on two things, trends in inflation and trends in interest rates. And the problem, and the reason you're seeing the market so volatile, is there's an enormous range of outcomes on both of them. So people do models on where they think, inflation is going to be, or where interest rates are going to be, or the economy is going to be, and they plug these models in, and you get estimates on earnings, and you get estimates on where you think the stock market's going to go. But if your range of outcomes is very high, you can get numbers all over the place, and that's what's happening with the market. So on things like inflation, is it going to eventually come down in 3 to 6 months? Is it going to stay really high? Is oil going to be $90 or is it going to be $150 a barrel? Those are ranges of outcomes that are really wide. There is interest rates. Is the 10-year 6 months from now going to be at 3.5%, or is it going to be at 1.5%? Those are very wide ranges of outcomes. So it's not clear. And I think the markets have rallied because Powell, the head of the Federal Reserve, Jay Powell, convinced a lot of people that the Fed's going to be really aggressive on inflation. They're talking about a 50 basis point hike next summer, next Fed meeting in May. But at the same time, they're not going to derail the economic recovery. They're not going to raise rates so fast that they'll send the economy into a recession. Well, this is a pretty neat trick because inflation is running very high. So the Fed's going to have to be very aggressive to sort of catch up to inflation. And traditionally, when the Fed gets really aggressive on interest rates, that's the killer of bull markets. It also tends to often precede a recession. So how do you do this? For the moment, Powell, who's a master communicator, in my opinion, did a great job at the press conference last week and basically saying, listen, we're going to get aggressive on interest rates, but my base case is there's not going to be any recession. Well, okay, the market's given him the benefit of the doubt. That's what's going on. That's why we've been rallying recently. The rally really started with Powell's press conference last week. So all this is good news. I hope he's right. He's been doing a great job so far, but there's a very wide range of outcome that you can possibly had. So look, for example, at commodity prices. That's driving markets near term. When commodity prices are down, and commodity stocks are down, I mean, oil stocks, material stocks, markets usually are up. And that's what's happening today, and vice versa. If commodity prices, oil goes up, oil stocks go up, material stocks go up big, usually it puts pressure on the rest of the market. So you can see that's what's moving the market. So it's tough right now. But for the moment, the market is giving Powell the benefit of the doubt that he can pull off this hat trick of aggressively raising rates and not derailing the economy. We'll see.
So, Bob, like you said, inflation is definitely on a lot of people's minds right now. How should people be investing during periods of high inflation?
Well, the knee-jerk answer, I don't give investment advice, but the knee-jerk answer is you buy commodities and commodity stocks. And that's what's going on. You see this, right? This is why energy, which used to be 3% of the S&P 500, all of a sudden it has had tremendous returns this year. commodity stocks, material stocks, look at steel stocks, look at fertilizer stocks, tremendous returns this year. Obviously, the crisis in Ukraine has exacerbated this, but this was going on before that. So there's the old knee-jerk reaction as you sort of buy commodities. But the one thing you ought to remember is the stock market does very well during periods of moderate inflation. It always has. And the reason it does is because corporations, for the most part, have pricing power to raise prices to deal with inflation. This gives them a tremendous edge. This means your margins don't erode dramatically. Now, this doesn't always happen. And during periods of rapid inflation, like the 70s, companies couldn't raise prices fast enough because people would revolt. You can get from $1 to $1.05 on a bar of chocolate, but if you go to $1.40 for a bar of chocolate, people are going to say no. You'll get demand destruction. So that's sort of what happens here. What everyone is sort of looking for at this point, ultimately, is demand destruction. And I think moderate demand destruction is very good for the stock market. So right now, just remember the base case. Stocks do well during moderate inflation. They're fine. Rapid inflation becomes a little more problematic. So if you look at, for example, some of the retail companies, some of the food companies, there's been some concern about pushback. There's concern about pushback on used car prices. Used car prices are up 30% year over year. Carvana came out the other day and said, we're seeing people say, no, we don't want to buy a car. Too expensive. That's pushback. That's demand destruction. The way you sort of halt rapid inflation is you create demand destruction. People just say no. You say, all right, I'm not going to spend, $800 a night for a hotel room, or I'm not going to spend 30% more on a car. Home prices are up 10%. So people may not want to buy a new home or get a new home with prices up like that. So this demand destruction idea is very much at the heart of what the Federal Reserve does when it raises interest rates. It tries to lower demand. This is not a perfect vehicle, though. It's very difficult to do this elegantly and in a way that doesn't have unforeseen consequences. So that's why I'm saying this is a very tricky moment here. The Fed's got to do this in a way that doesn't hurt the economy. And what I think is going to happen this summer is, first of all, just on traveling, everybody wants to go out. And people are paying prices that are crazy for hotel rooms, car rental prices, gas prices. There's going to be a point, though, where people are going to push back. And I think that you'll see that this summer. You'll see headlines about people not taking long car trips because gas is staying near $5 a gallon. That may not be a bad thing. That is how you stop and slow down inflation. You just have people walking away and say no. So if somebody wants to charge you, pick a number, $800 for a hotel room for your vacation, that 4 years ago was $300 a night or $400 a night. Now they want to charge you $800. If people want to go out and do it now because they're crazy and stir crazy, they'll do it. But maybe in a few months, enough people will say, you know what? I'm not paying that. No way, to walk away. That's how the prices will come down and people will sort of stop inflation. So your answer was, how do you deal with high inflation? The answer is stay invested in the stock market. Generally, moderate inflation doing well. Earnings are still holding up, although it's a little tricky right now with the earnings situation. And if you really are interested, the classic way is to play the commodity game. But I would caution you that this is it's a little dangerous to buy commodity stocks with oil, at $115. That train has left the station. That play has already been done.
Yeah, it is interesting to see these higher prices and, like you said, people getting stir crazy and wanting to get out, how that, kind of works together. So Bob, I was wondering next if you could kind of talk about the energy sector and your outlook for that sector.
Well, the simple and short answer on that is hydrocarbons are back. Oil's back. Non-renewables are back. And it's back because of Ukraine. You look at what's going on, what's happening here. First off, long term, everybody's in favor of renewables, wind and solar, geothermal. Who isn't? I'm in favor of it. I vote yes. The problem is that it takes longer than people think to make the transition. And some people have tried to make the mental and physical jump sooner than it was feasible. Ukraine has really exacerbated a problem here. Europe's really in trouble. In Germany, they had decided that just to make sure they look good, they were going to basically give up on oil. And we're going to rely largely on importing oil and natural gas from Russia. So this made them look like, we don't go out and drill for oil and natural gas. There isn't much in Germany, but we're relatively clean. Also, they decided to give up their nuclear power plants, which were a significant part of their energy production. Well, not great. Now, they didn't foresee the Ukraine crisis, but this is a problem now for Germany. They have decommissioned or on the process of decommissioning all their nuclear power plants, number one. Number two, they are at a point now where they're going to have to boycott Russian oil or natural gas, too. They're not going to turn on the pipeline that they built. And now they're in trouble. This is why we're holding high-level discussions to ship liquefied natural gas from the United States. We have an abundance of natural gas that can be liquefied, largely in giant facilities in Louisiana. It can be shipped, but it's expensive, and they don't have the infrastructure in Germany. There's no place to ship it to on the scale that they need to. So think about this. This could take several years. You have to build these giant things if you're going to assume that you're going to try to reduce Russia's influence. Well, so the short answer here is that for the near term, hydrocarbons, that means oil and natural gas, are kind of back again. In the long term, I think that this is going to be good for renewables because it's going to accelerate the need for wind, solar, and make it feasible too. But you're going to see Germany, for example, this year, I'm pretty sure they're going to just stop decommissioning their nuclear power plants. Several were coming offline in the end of this year, and several already have come offline. I'll bet you they'll restart that. And I know, of course, there's a lot of dangers with nuclear power, but it is extremely efficient form of energy. And if the choice is that, or people having no way to heat their home this winter, which is a very real possibility in Germany, if they decide not to take Russian natural gas, they're going to have to make a deal somehow. So I know everybody thinks, oh, this is the death of renewables. Nah, it's gonna come back in an even bigger way because long run, we're heading in that direction anyhow. This is just going to accelerate that. But don't kid yourself about oil and natural gas. It's going to be pretty important for the next couple of years.
So Bob, something else that we talk a lot about here on Market Matters is long-term investing. So we got a question from someone who asked, what should people consider when they're picking stocks for long-term investing? What do you think?
Well, the most important thing that you should consider is not even the level of the stock market, or is now a good time or bad time to get into the stock market. That's the wrong question. The most important things to look at is your age and your risk tolerance. If you're 30 years old, you are probably going to be alive for another 70 years. Think about that. You'll be alive if you're 30. A young person should work on the idea they're living to 100. I'm working on the idea I'm living to 90. That will give me, a little less than 25 more years. And people are underestimating how long they're going to live. That's the first thing. So what's your age? Your risk tolerance. If the market dropped 25%, could you handle that? If you're 30 years old, you shouldn't care. You really shouldn't. It's not going to matter. It's just an opportunity to buy lower, because what are you going to do? You're going to be around another 70 years. Do you think the market drop in 2022, 20% is going to matter in 2032 or 2042? It's not. I started investing very late for in my 30s after I joined CNBC in 1990. And that was late. I made a terrible mistake waiting so long. But there were drops in between 92 and 96. You think it mattered in the long run now? Nobody even remembers any of that. I just stayed invested. And that's what you should do too. Don't worry about it and don't try to time the market. This is the biggest mistake people make. They think they know when to go in and when to go out. Remember, market timing, you got to be right going in and going out. Nobody gets that right. Not even professionals get that right. Long-term stay in the market. You don't know the right day to buy stocks. You can look at any of the historical studies on this. There are always, every year and every decade, there's 10 days where the market was up the most. There's 10 days when the market was down the most. If you weren't in the market on the 10 days when there was up the most, your returns are way, way lower than the return at the end of the year. The problem is you have no idea what 10 days those are. There is no way you will know in advance. So market timing, you may think you could do it once or twice, but try doing it every day for the next 60 years. Good luck. It's not going to work. So do yourself a lot of trouble. Save yourself a lot of trouble. Have a moderate risk tolerance. If you're young, there's no reason why you couldn't just buy the S&P 500 and just hold on to it for years. That's an easy way to own the market. You're owning the biggest 500 companies in the United States. That's the market. The S&P is 80% of the market value of the United States stock market. 80%. And you can buy that any form on an exchange traded fund. IVV is an iShares one that BlackRock runs. VOO is the one that Vanguard runs. It doesn't matter. They're 3 basis points. That means they charge you $3 for every $10,000 that you invest. That's pretty cheap to own the stock market. For $3 a year for a $10,000 investment. Pretty cheap. And you're set. You don't have to think about it. So that's what I would consider. And the other thing, of course, inherent in what I just said is broad diversification. I know you think you're a stock picker. I know you think you're a genius. I know you think you can do it. You can't. It is extraordinarily difficult to buy and sell stocks for the same reason I just talked about before. Owning individual stocks is even riskier than owning indexes like the S&P 500 or the S&P oil sector of the S&P 500. You think you know how to trade those stocks. History suggests you do not. The academic literature is overwhelming that people who actively trade, I don't mean, oh, you did one trade and you just made $5,000 and you think you're a genius. I mean, you do it every day for the next 30 years. You're not going to come out ahead of owning an index fund. You won't. So I'm a Jack Bogle disciple. I have never wavered in this. I met Bogle in the mid-1990s. He's the founder of Vanguard. There is no evidence or reason for me to change my opinion after all of these years. If you really want to actively trade, we have wonderful active traders on CNBC all the time. I think they're terrific. I would urge you to listen to them. If you want to scratch that itch, I would suggest that you listen to Jack Bogle, who advised people to take 10% of their portfolio and go ahead and trade it, but take the other 90% and put it in a long-term diversified fund. That's my advice, and that's what most people who are professional advisors will tell you.
That's great advice. Thanks, Bob. So kind of an interesting transition here to meme stocks, which are getting a lot of buzz. Meme stocks like GameStop and others. Do you think the meme stock mania is making a comeback?
No. Look, GameStop went up big this week. I think it's up 50%. It went up because Ryan Cohen, who's the chairman, disclosed that his investment company bought 100,000 shares, which is nice. And it's nice he's putting his money where his mouth is. There was no change in the fundamentals. The earnings report was terrible. There is no indication at all that that company is suddenly going to become a major player in the digital video game market, which is where it is. It isn't a wonderful company. It's a company that consists of people who like to play on video game consoles, and many of them like to use old-fashioned, CDs. The good part of the company's revenue comes from people actually what's called the collectibles market, people trading old CDs. This is great. I'm a collector. I used to collect comic books in the 60s. I collect rock posters. There's one right behind me. It's a Led Zeppelin poster. It's a small community, but I like it. It makes me happy. And people like to trade games. It makes them happy. So it's a wonderful business. But it isn't a business that's going to change the world. And they're not going to challenge the really big players in the digital video gaming space. They're just not. I think it's I like the company, but I don't understand the people who buy it at $100 or $150. And you could say to yourself, well, okay, do fundamentals matter? The fundamentals do not match the stock price. It's not even close. It's like you're in a different universe. If you want to buy it on some other metric, it doesn't make any sense on a technical basis either, by the way. But if you want to buy it on some other metric, whatever, hodling, whatever, go ahead. But long-term, stocks will trade on their fundamentals long-term. I would, again, just tell everybody, this is one of those little things where you think you're a genius and you're not. Stick with stocks that are broader. Stick with index funds is my advice. But I would not get wrapped up in the meme stock phenomenon. By the way, I think very highly of the people who helped originate the whole thing. I think a lot of those people had very good insights. Robinhood has 20 million people, 20 million accounts. And most of those accounts don't have much money in them, maybe $5,000, not much. But they're young and they're interested and they're enthusiastic. And that's what I like. I like all those young people. 20 million? Hell yeah. I vote yes. And I hope they stick around. I want them to stick around and become longer term investors and more serious investors and learn about the fundamentals of long-term investing. So I don't want them to walk away and say, oh, the whole thing's rigged by, a bunch of high frequency trader or the Illuminati or some vast hidden conspiracy that they believe. It's not, by the way. It's not. There is no. I've been looking for the Illuminati who run the world for years. I'm just asking people to let me in. That's all I want. Just let me into the Illuminati so I can run the world. And it's not there.
Not going to happen.
I've been searching and searching for 30 years. There isn't any. There's no conspiracies. It's just a lot of people out looking to make money. That's all. That's not a conspiracy. That's just a bunch of humans out trying to survive. So it's not that interesting. So I hope those 20 million people stick around because I really like them. I like their enthusiasm, and they're going to be great investors long term. And some of them are going to come up with great ideas that are going to make tons of money. And I'm eager to hear them. I really am.
Yeah, for sure. I definitely think, like you said, Robinhood has been such an entry point for so many young investors, even friends that I have that I've never heard talk about the stock market before. Now we're talking about Robinhood. So it's very interesting. And yeah, we'll see what happens long term. But Bob, our last question now is about the SEC. The SEC issued a new climate proposal. What does this mean for investors?
Gary Gensler is the head of the SEC, and I cover the SEC. I've been covering them for 25 years. This guy, Gensler, has more ideas and proposals than anybody I've seen in 25 years. It's exhausting covering him. He's like a proposal a week. This is the good news. The bad news is a lot of these proposals basically revolve around the idea he wants corporate America to disclose more about everything. A few weeks ago, it was about cybersecurity. He wants them to tell us more about any cybersecurity incident they've had, what they're doing about it, blah, blah, blah. In theory, this is a good idea. What really happens here is that there are so many proposals he's making that would require disclosure that it's going to be an enormous burden on companies to hire lawyers to do all of this disclosure. So the compliance business is going to explode. Now, these rules are only in the proposed stage. They've got to put them out for public comment. It's got to go through a process. So it's not clear they're all going to make it to the finish line. But this one they did last week on climate disclosure is really big, because what they're asking for companies is, we want you to tell us about things like greenhouse gases, not just that you are emitting, but around your energy consumption, and even potentially around your suppliers outside of your immediate control. Well, think about this, an enormous amount of information. And the problem is, there is a very large part of the population of corporate America that says this is first outside of the SEC's mandate. The SEC's mandate is to protect consumers and provide fair and orderly markets. This is outside that mandate. And there is an enormous controversy as well from people who are basically saying this is a backdoor way to create new laws. So by pushing people and demanding to know, what are you doing about climate change? You're essentially creating a law that says you must do things about climate change, even if there is no law in existence about that. So I hope you're clear on what I'm saying here. The argument against this that is being made is that this is a backdoor way to end run Congress, whose rationale, whose purpose of existence is to create laws. And so there may, if this gets to a final stage, actually even be a legal challenge. There may be people actually trying to sue the SEC over this. So this is enormously complicated. Now, let me give you the other side. The other side is the train has left the station. People are going to these corporations and asking, what are you doing? How much do you pollute? They want to know. Are you trying to use less fossil fuels? Should you? They're responding. The companies are responding to what people want. So you see the conflict here? The corporations are responding to what people want. The SEC is now responding to what people are telling the government. We want more information. We want less fossil fuel use, less greenhouse gas emissions. And Gensler, who's a Democrat, is responding to this by going to companies saying, tell us more about what you're doing. And now other people are saying, wait a minute, no, you shouldn't be doing that. You shouldn't be trying to mandate what people should be doing or even reporting. So it's a very interesting policy question for everybody. What is the role of the SEC? Do they even have the right to ask these questions? And I think it's wonderful. Here's my sense. My sense is that they do have some rights to ask these questions, because if your goal and the SEC's primary reason for existing is to protect investors, that's why the SEC Act was created in 1934. That's what it says. Think about it. If you're investing in Exxon, do you want to know what they're doing? If you're investing in any company, should you know? I'll give you another example. Suppose you want to buy municipal bonds. And you want to buy a municipal bond in Miami Beach, which is, in a very serious flood zone. They're going to have some problems in the next few years if ocean levels keep rising. If I want to buy municipal bonds and I work for California Teachers Retirement, I sure as hell want to know what Miami Beach thinks about the flood damage in Miami that could happen. I'm not going to buy a municipal bond unless I know that. So I'm going to demand that the city of Miami Beach, which is floating bonds, to me, they want me to buy these bonds. I'm not buying them until I know what their assessment is of the flood potential in Miami Beach. So you see how climate change can be very important, and it can be a very important issue around protecting investors. So my sense here, this is just me talking, is that the SEC certainly does have a certain amount of rights to ask. The question is how far. There can be a thing called overreach, where you're just asking so many questions now that it's just unreasonable. And I think there's going to be a food fight over that. It's actually really interesting. A lot of times I find this kind of like, you get lost in the minutia of legalese. This is a really interesting question. Should we be having a federal agency asking U.S. corporations about what their climate policies are. That's going to be a great question. And this is going to be a slow process. They'll have companies will have 60 days to respond to the SEC statement, and then the SEC will collate all the information. They'll either change their proposed rule or they'll put it out for a final vote down the road. This will probably happen later this year. And I anticipate if they try to go to a final vote, there'll be pushback, and there may even be a lawsuit about it. A lot of fun to watch.
Yeah, it'll definitely be interesting to see where that goes, and I know that you'll be watching that closely for everyone. So
yeah, it's going to be great.
Mm-hmm. Well, thank you again to everyone for sending in your questions. Another great week of Market Matters. Thanks, Bob, for answering.
Okay, thanks, guys, and thanks for the great questions. You hit all the right issues, but you always do. You guys are amazing.
Yeah, we always get some great questions. So feel free to leave a comment, and maybe we'll answer it next time. So see you again in a couple weeks, Bob.
All right, take care, Katie.